What's up, everybody? It's October 27th, and this is another audio episode of Is It Monday Yet?, where we touch on major market events from last week and what's on tap for this coming week. So let's start with a recap of last week's key developments. AWS, let's start with that. Amazon Web Services experienced a significant service disruption that impacted numerous clients and consumer apps. Of course, my very own Beehive and Substack got affected as well. The outage highlighted the continued concentration risk in cloud infrastructure as many major platforms rely heavily on Amazon Web Services. While the disruption was resolved within hours, it serves as a reminder of the systemic importance of cloud service providers to the modern digital economy. Now think about this. This was only one data center that went out. Just imagine if two data centers went out at the same time, or even three. The United States has about over 5,000 data centers. So this is a risk that we have to pretty much pay attention to, because if data centers go down, if this is a common occurrence, even if it's once every 6 months, it'll be a problem. So just something to ponder or think about going forward as we build out more data centers in the US. On the earnings front, Netflix delivered impressive results that beat analyst expectations across multiple metrics. The streaming giant reported revenue of $9.8 billion, beating the estimate of $9.7 billion, representing year-over-year growth of approximately 15%. More importantly, Netflix added 5.1 million subscribers in the quarter. This is the key thing with Netflix. How many subscribers do they add on a quarterly basis? Now, that 5.1 million subscribers crushed the expectation of 4.5 million. Earnings per share came in at $5.40, well above the consensus of $5.12. The company's ad-supported tier accounts for over 50% of new sign-ups in markets where it's available. Now, if you pay attention to what's going on with Netflix, if you notice, Netflix is moving over to more live-action content. And I think that's going to start bringing in a different subscriber base. You have WWE, you have NFL games, and you just had the Canelo Crawford fight boxing match that was a couple of months ago. So what Netflix is doing, they're bringing in a whole totally new, different subscriber base, and I think that's a really smart move. We'll have to watch how that all plays out. On the earnings front as well, Intel delivered results that exceeded lowered expectations and demonstrated tangible progress in its multi-year turnaround strategy. The chip maker reported revenue of $13.3 billion with earnings per share of 17 cents, beating reduced estimates on both metrics. While the headline numbers reflect the transitional nature of Intel's business, the underlying trends are encouraging. Now, this is a case where the government has a vested interest in Intel. I believe the federal government has taken a 10% stake in Intel, and they will do everything in their power to make sure that that works out. Because what this administration doesn't want to do, they don't want to have to rely on Taiwan, which is too close to China, because at any point China can take over Taiwan, and then what happens to domestic manufacturing for the US? It's a big risk. I would say perhaps the most important, significant news for last week was the report of October CPI, which came in at 3% below consensus estimate of 3.1%. This marks another step in the deflationary trend we've been observing for the past, I would say, a few months. Core CPI, which excludes food and energy, rose 3.3% year over year, also cooler than expected. Despite earlier concerns about data collection disruptions from the government shutdown, the release went smoothly. Notably, we have not seen a reacceleration in inflation that many economists had projected would occur by this point in this year. The continued moderation in price pressures provide important context for the Fed's policy decisions. Now, this is a big deal because we have not received any economic information for the past month and a half. So there was an idea that we would have higher inflation, but it seems as though inflation is not taking off like people expected. So it came in at 3%. The expectation was 3.1%. So it came in cooler than expected. And now this gives leeway for the Federal Reserve to do its thing and cut interest rates. Now, turning to the week ahead, we have a substantial amount of market events on the calendar. Yesterday, reports emerged that the U.S. and China have made meaningful progress towards a potential agreement following weeks of escalating tariff tension. While details remain limited, any resolution to the trade conflict would have significant implications for corporate earnings, guidance, supply chain planning, and overall market sentiment. So this is just a do-si-do that's been going on. President Trump says something to China, China retaliates, and then there is pretty much market uncertainty. Markets trade down. Then a couple of weeks later, these guys are going to pretty much join up and have a sit down, and then markets go up. So it's key to not panic whenever there is tariff discussion, because from what we've seen in the past, it'll all work itself out. Now, Wednesday brings to us the Federal Reserve's interest rate decision, followed immediately by Chairman Powell's press conference. Market participants will be going through the policy statement and Powell's comments for signals about the trajectory of monetary policy. Given the recent inflation data and labor market conditions, the Fed's measures will be critical for rate expectations going forward. Now, with the cool CPI reading that we received, we're going to get rate cuts, at least 2 rate cuts for the end of the year. And so that's a good thing for markets. What we should look at is, what his commentary says going forward into 2026. Now, Wednesday also features a heavy slate of mega cap earnings from Microsoft, Alphabet, and Meta. These companies will provide crucial insights into enterprise cloud spending, digital advertising demand, and AI infrastructure investments. Revenue beats or misses from these technology leaders will likely influence sector-wide sentiment, given their outsized weighting in major indexes. Now, what we're going to look for from these for these companies, these are 3 hyperscalers. So what's really key is during the earnings call, will they increase their AI budget? They probably don't need to increase their AI budget because they're already have increased it immensely over the past year or so. But it'll be interesting to see what have been the payoffs for their capital intensive, these very, very major capital intensive moves that they've been making within the AI atmosphere. So it'll be interesting to see what happens and what they have to say with what has been the return on the investment, if any, so far. And so this is it for Is It Monday Yet? I'll check in with you guys next week. Have a great work week.